Good evening, everyone. Once again, my name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you so much for joining. Vivian, thank you so much for being with us tonight. So we are tonight joined by Vivian Sze from JP Morgan Asset Management. The topic of tonight is income investments, and we have structured the evening in a few sections. I'm going to go through them in a second. The bigger part is going to be with Vivian giving us kind of the JP Morgan perspective on where we are in the cycle and how you can think about income investment strategy in this current environment. Now, before we go into the content, let me kind of mention a couple of administrative topics. First, we're going to be very happy to take questions. We'll kind of moderate the questions for Vivian, and obviously if you have for myself as well at the end. You can use the Q&A function in Zoom. If you don't see it, you just click on More, and it's going to be under More. If you are following us on YouTube, you can also put the question there, and my colleagues will actually make sure that I receive those questions, and I'll moderate that and try to make sure that I ask the most relevant one and the more common ones to Vivian at the end of this. You see there is a QR code on this slide on the right side. That's a link directly to StashAway's income investing product. I'm going to talk about it later, but if you are asking yourself, what is this, the QR code about, this is it. It's a link, direct link to our income investment information and product. Okay. So as I mentioned, we've structured the evening in a few sections. I'm going to speak very briefly about StashAway for those of you that might not be familiar with us. Then I will make a step back and talk a little bit about bond investing in a kind of a starting from the very basic terms. What I want to make sure is that everyone has a bit of basic understanding before Vivian goes into kind of more complex explanations. And then at the end, after Vivian will have done her presentation about, where are we from a macro perspective and what does it mean for income investing, I will also kind of translate some of these learnings and perspectives on what it means for our income investment portfolio, which is also kind of powered by JP Morgan. So it's done in partnership with JP Morgan. Okay. As mentioned, if you have any questions, please use the Q&A function or the YouTube kind of question box. So first of all, on StashAway, we are a digital wealth management platform. We have been around since 2017. The way we think about what we're doing is that we want to make it simple and cost-effective to invest intelligently. And this is what we've been doing with JP Morgan with regard to the income investment products. We make it extremely simple to invest alongside kind of one of the best fixed income investors in the world. We make it extremely cost-effective, as we charge very low fees on the product. And it's a very intelligent solution, which is, it kind of invests in different pockets of the fixed income market and kind of actually manages those pockets over time as the macroeconomic environment changes. Obviously, this is specifically to the income product, but this is the same approach we take on every product we launch and manage over time, from cash management to kind of general investing to actually private markets for accredited investors. We are live in 5 markets, in Singapore, Malaysia, Thailand, Hong Kong, and the UAE, Dubai. And in each of these 5 markets, we're regulated by the local regulator. So MES in Singapore, SE in Malaysia, etc., etc. I'm not going to go through all the kind of the accolades that are listed on the website. This is just for you to see that we have been around for quite a bit of time, and we've been recognized as one of the companies changing the way people manage their money in this region of the world. We have 4 groups of products. What we call the core portfolios. This is what we started with in 2017, so 8 years ago, where we have managed portfolios that enable people to build their exposure through different asset classes. So what is flagged as most popular on the top left is our general investing portfolios, which can either be powered by StashAway or BlackRock. We have obviously the passive income that we're going to talk about tonight later, powered by JP Morgan. And then we have flexible portfolios where you can build your own asset allocation using the same building blocks that we use in the other portfolios. We have a set of cash management offering. We call it StashAway Simple, Simple Plus, Simple Guaranteed, as well as we have a US dollar cash yield, which invests in US Treasuries. We have a few thematics portfolios, I'm not going to go into the details of that. And we have alternatives available to StashAway reserve clients, to accredited investors, from private equity to private credit to crypto ETFs. Tonight, as mentioned, we're going to focus on what you see on the left side, passive income. So, investing in to have a stable income, and we do this, as I mentioned, in partnership with JP Morgan. Now, what is bond investing? And I'm going to start really, really, really from the basics, because I know that some parts of this might be counterintuitive. So how does a bond generate returns? If you invest $100 in a bond, the goal for you is to receive a coupon, like an interest payment on a yearly basis, as well as potentially benefits from price movements. So in the example here, which is obviously a bit simplified, and Vivian, pardon me for the simplification, this assumes that you have a 5% interest payment, so 5% coupon, which does not change for the life of the bond. So if you buy a bond that is issued either by government, the Singapore government, or by a corporate, Singtel, and that bond gives you 5% coupon, you're going to get this 5% coupon year after year after year after year. And if the bond is 10 years long, if you hold the bond, you're going to get this 5% across the 5 years, assuming the coupon is fixed. At the same time, there can be price movements. And I'm going to talk about that in a second. Obviously, the price movements can be positive or negative. If you hold the bond until maturity, the price movement will be zero. So, assuming that, the par is 100, you get your 5%, and over time, at the end, you're going to get, $100 back plus the $5 coupons you have received over time. Now, let's look a bit more into the details of how the changes in the bonds price relates to the yield. So this is where maybe it gets sometimes counterintuitive. So when interest rates rise, the bond prices drop, and vice versa. So if the interest rate go from 4 to 5%, the bond you bought for $100 might actually go down to $99, $98, $97, depending on how long is the maturity of the bond. So again, interest rate rise, bond price drop, and vice versa. So if interest rate drop, bond price rise, okay? And the reason is that if you bought a year ago a bond at $100 that was giving you a 5% coupon, and today you can buy a similar bond which gives you a let's say 6% coupon, so let's say the interest rate rise, obviously you would, in the secondary market, the old bond that gives 5% will be worth less than $100, because in practice it needs to give you the same return of the new bonds. And that's why if interest rate rise, the bond price drop to adjust for the new target total return that you want to have. Okay, so when rates fall, existing bonds become more valuable. When rates rise, existing bonds lose value. I hope I clarified rather than confuse you further. But this is a core principle you need to understand, because when people talk about yields, you need to understand that yields going up means that you're gonna receive a higher income on your bond investments, but that whatever bond investment you have today in your portfolio will actually or have already lost a little bit of value. Okay. Now, in a falling rate environment, which is where the markets think that we are, as you know, the central banks across the world have been raising interest rates until around a year ago, because inflation was growing very much and was becoming a problem. And by raising interest rate, the central banks tried to kind of cool down the economy and therefore reduce the speed of which the inflation was rising, and trying to bring inflation down. Around a year ago, the central banks have started to bring rate down. So, the Fed rate has been cut a few times since a year ago. And so we are therefore now in a falling rate environment, and the market expectation is that this falling rate environment will continue. And I'll let Vivian speak about it in more detail later. Assuming that is true, if you invest in bonds, you kind of lock the rate a little bit. What you see on the chart here is assuming that in the next 4 years, interest rate going from 4% to 2%, and there are a bunch of simplification in this chart I'm going to talk about in a second. If you invest in kind of treasuries, so in cash, let's call it, that gives you exactly the current interest rate, you're going to get 4% today, you're going to get 3% next year, you're going to get 2% in 2 years, then 2%, then 2%. That's the green line you see here, okay? So your $10,000 become around $11,000 in 4 years when you do kind of 4% plus 3% plus 2% plus 2% plus 2%. If you buy a bond that has a 4% yield today and you hold it to maturity, then then you are on the blue straight line in practice, assuming you hold it to maturity. So you're gonna get to $11,600 in 4 years. So you actually continue to get your 4%. If you buy a bond and then you keep looking at what is the value at 4% interest rate, and you keep looking at what is the current value of the bond, what is going to happen is that it's actually going to go through the blue, dark blue line you see here. So you're actually going to you're going to see returns a bit kind of more at the beginning because of what I said earlier. Interest rates are going down, and therefore the price of bonds go up. And so you still get, if you hold to maturity, your 4%, but you might actually get it a little bit earlier if you actually sell your bonds, or if you look at what the price of those bonds is over time. I hope I clarified a little bit some of the core logic. Now, when we launched together with JP Morgan the product in Q3 2024, we were in a situation where inflation was softening, but still above target. Economic growth was still very solid, and the markets thought we were at peak interest rates, and the markets were waiting for rate cut cycle to begin, which we thought was a great place to launch an income product, in practice, peak of the market, peak of interest rate market. Where we are today is that inflation is still softening, even if at a lower pace, kind of stabilizing, actually. Economic growth is moderating, and obviously, if you read the newspapers, as you know, there has been a lot of discussion about impact of Trump, in both positive and negative ways, and how that might impact economic growth. And the rate cutting cycle has started, and it's probably now slowed down versus what used to be market expectations a couple of months ago. But we are now not anymore at peak interest rate. In fact, this is my last slide before I pass it on to Vivian. In fact, the golden line here is the Fed target rate. So this is kind of a very short-term treasury rates. And as you can see, we went from around 5.5% to 4.5%, so 100 basis points down. What you see in blue is the 10-year treasury rate. And the 10-year treasury rate is not something that the Fed actually controls directly, but it's more the market that decides, how much market participants are willing to pay for 10 years exposure to US Treasury right now. And as you can see, while Fed funds target rate came down in the last few months around 100 basis points, actually the opposite happened for 10-year Treasury rates. As you can see, they actually rebounded back, and the curve has now not inverted anymore, at least on the 10-year horizon, where in practice Fed fund rates are now giving more or less the same return of the 10-year treasuries. And that's one of the reasons why we called the session tonight from cash to income, because obviously in the last 2 years, keeping your money in cash products, for us was simple and simple guaranteed, was giving actually a very, very meaningful yield, especially given the, very, 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 very low risk you are taking with that. As interest rates are coming down, the question is, are now income product becoming more interesting? Because, Fed, again, cash rates are going down, not just on StashAway, obviously everywhere. And therefore income can become a more important part of your portfolio, obviously with different set of risks and things you need to take into consideration. I guess this is hopefully a good introduction for Vivian to take it forward from here. Vivian, again, thank you once again for being with us tonight. I will be the one clicking, so just tell me as you progress, and I'll be happy to click for you.
Thank you very much. Thank you, Michele, for setting the scene so well. And good evening, everyone. It's great to be here speaking to you today. So, we're a little over 2 months into 2025. And it's already been a flurry of news, notably around US policy, tariff announcements, etc. So the past couple of weeks have been quite disoriented for a lot of us. But I think the good news for bond investors is that fixed income is once again providing diversification. So if you look at yields on the 10-year US Treasury bonds, they're down from around 4.8% at its peak back in January to now around 4.2, 4.3%. So we're seeing 10-year yields essentially headed toward their seventh consecutive week of lower yield. And this is the longest streak since 2019. And as Michele mentioned earlier, when yields go down, bond prices go up. So we're seeing a very nice rally in bond markets. And as diversification really come back into focus, I think it's very timely that we're having this session today. So we're going to try to unpack what's been top of mind for markets. We're going to try to talk a little bit about what could be the implications for bond investing. And then more importantly, why bonds are actually quite well positioned as we look ahead. So to start, let's first just take a step back and look at the state of the economy. Because as bond investors, knowing where we stand in the economic cycle is really critical to making informed investment decisions in fixed income. This kind of insight is what drives the kind of returns we can expect for bonds in the future, and it's going to help us find the signal through the noise in today's environment. And so, in our view, our position in the economic cycle is, I would say, shaped by trends in two key areas, and that is growth as well as inflation. So let's first take a look at growth on the next slide of the presentation deck. So we maintain our broad outlook of a very resilient global economy. As we look across regions, the picture is obviously somewhat mixed, but we do continue to expect the US economy to sort of lead the way. So what we're showing here in this chart is the quarterly annualized GDP growth in the US, as well as the component contributors to that growth. Now, historically, the US economy has on average grown at around 2% over the long run. So this 2% is what we call trend growth. In the last quarter, as you can see from the bar on the very right-hand side, the US economy expanded at around 2.3%. And actually, if you look at the historical parts, if you look at since the third quarter of 2022, the US economy has actually put up 10 straight quarters of growth that's at or above trend. And what's really been powering the US economy forward has been the light blue bars here. So the powerhouse here is really consumer spending, which accounts for around 2/3 of the economy and really has been the engine of growth supporting the overall US growth outlook. So as you can see, we've come from a very strong starting point. But what about as we look ahead? Obviously, there are uncertainty around the Trump administration's policies regarding federal spending cuts, tariffs, which have been key themes in recent weeks. These are policies that are expected to be a headwind to growth. But in our view, the Trump administration is essentially front-loading a lot of the painful parts of his agenda. And it's important to know that there are actually other policy agendas that we think will have different impulses. For example, tax cuts and deregulation, being some examples of that, which we think are actually going to be positive impulses and are going to be additive to growth. Now, what we've seen so far in the first quarter, year to date, is that there has been a softer patch when it comes to consumer spending momentum, as well as just general business as well as consumer sentiment. But on the other hand, we have also seen stronger than expected services as well as manufacturing PMI data. So clearly, there are still a number of cross currents that are still playing out. But what I would say is that overall, from a JP Morgan perspective, we still expect growth to remain strong, although to moderate from what we call above trend to at trend, so to around the 2% level as we look ahead in 2025. But that is certainly different from saying that the economy is contracting. Now, what gives us quite a lot of comfort is the state of the labor market. So if we go to the next slide, there are some interesting stats that I just wanted to talk through. So this page here shows the unemployment rate in the US in the gray line, and wage growth for workers in the blue line. And this is going back since the 1960s. And you can see that the two measures have had an inverse relationship historically. You can see that the labor market is slowing gradually, and the unemployment rate has trended slightly higher after reaching a cycle low back in 2023. However, we note that most of this increase in unemployment has actually been driven by increased labor supply rather than layoffs. Now, the latest unemployment rate, which we got from the jobs report last week, remains at around 4.1%, which is still quite a low level relative to history, relative to the long-term average of 6.2% in the US. What we did notice from the jobs report last week was that continuing claims did pick up a little bit, but initial jobless claims declined versus the prior week. And we noted that private payrolls continue to grow at a moderate pace, with growth essentially dominated by the services sector, so such as healthcare, social assistance, while the goods sector has also shown some improvement. Now, government employment actually rose despite all the headlines around layoffs and hiring freeze, and that was driven primarily by local government hiring. So the two kind of offset each other. But we would definitely be watching out for the next labor market report to see if some of that slowdown in hiring or layoffs at the federal level will start to show through in the data. But I would say that overall, we are still quite confident about the base case scenario that we're going to see some rebalancing in the labor market. We're going to see a decrease in job openings. It should get a little harder to find a job, and this is typical of an economy that is moderating, that is slowing. But we don't foresee large-scale layoffs because corporate profitability remains quite solid still, reducing the need for major labor cuts. So the punchline here is that we're not hitting any panic buttons. We're not expecting a significant rise in unemployment, and this is something that we pay a lot of attention to as investors, because the Federal Reserve does have this dual mandate of maintaining stable employment as well as maintaining price stability. So let's take a look at inflation on the next slide and take a look at where we're at and how far we've come. So what we're showing here on this chart is the headline consumer price index as well as the core consumer price index over the last 50 years. So core consumer price index excludes food and energy prices, which tend to vary a little bit more widely than other parts of the market. But examining both will allow us to see the trend in prices versus the long run averages. So you can see from the table here on the top right that the most recent reading for headline CPI was around 3%. It was slightly higher for core CPI, which is around 3.3%. Now, I think many of us would remember that inflation has really been a very hot topic since the pandemic. We did see U.S. headline inflation reaching about 9%, core inflation, getting to the 7% level at one point due to issues that we had with the global supply chain, which just wasn't able to meet the strong recovery in demand post-COVID. And this challenge led central banks around the world, including the Federal Reserve, to raise interest rates at really, I would say, unprecedented pace. And that in turn had a large impact on asset market returns. Now, when it comes to inflation, it has indeed been a very long and bumpy ride. But I would say the good news is that we've seen actually significant progress. We're seeing global inflation trends moving in the right direction, and what we call the sticky stuff. So, namely, services, shelter, they are showing some signs of cooling. Now, we do see an upside inflationary impulse coming from tariffs, and so we have kept our base case forecast sort of unchanged for the remainder of the year, with core inflation landing at around 2.9% by the end of the year. So still slightly above the central bank target of 2% over the run. Tariffs at the end of the day will have an impact on inflation, but we think it's important to know that this is not going to be a recurring impact. It's a one-off impact when you're measuring whether it's month-over-month change or year-over-year change. Once the tariffs come through, it will be reflected already, unless really the U.S. administration is adding 10% tariffs every single month, which is not the case. But with that said, overall, we do acknowledge that risks are tilted to the upside, even though that the base case scenario remains that core CPI is going to be still, roughly around that 2.9 to 3% for the remainder of the year. Now, what does this all mean for central bank policy? Now, if we go to the next slide, I think it's important to address, we want to know where the policy is heading, because over the long run, rates are essentially driven by monetary policy. When we look at history, over the last 60 years or so, really about 3/4 of the move in the 10-year has been explained by what happened with policy rates. So this is kind of where we want to anchor as bond investors. While inflation is expected to settle at around 3%, and yes, it is above the Fed's 2% target, we don't think this is actually a major concern for us or for the Fed, because it is extremely hard to envision how or why we should go back to the inflationary world we were a few years ago. And we say this after even thinking deeply about the impact of tariffs. And so this backdrop of normalizing inflation with a very low chance of inflation picking up significantly, and then secondly, a slowing economy, but at the same time still one that avoids a recession. This is exactly what central banks want to see. So we know that the Federal Reserve, they did decide to maintain the Fed funds rate in a range of 4.25 to 4.1.5% during their last meeting back in January. It was as markets had anticipated, and essentially ending a 3-meeting streak of rate cuts that started in September last year. And this was mostly because there were a few reasons to ease policy further, as we were still seeing pretty solid economic activity, a pretty steady labor market, and then also inflation being a little bit more sticky in recent months. But zooming out, we think overall the press conference and some of the narratives that we got after the meeting actually had a slightly more dovish tone. We think the Fed is looking at data to really guide what they should do. There is definitely uncertainty regarding economic forecasts, particularly in periods of shifting policy, and so the Fed is not on a preset course. They're responding to information that they have in hand, rather than trying to preempt or really predict what will happen, given the lack of clarity on a number of issues, including the Trump's administration's policy agenda. So overall, the outlook is looking a little bit choppier, but we do believe that a soft landing in the U.S. economy is still our base case. We do expect the Fed to ease 2 times this year, likely in this second half, to really backstop any slowdown in growth. And the Fed very much wants to avoid a scenario where it has to start raising rates again, just given the potential confusion that this could signal to markets. So that's going to be a very high bar for the Fed to actually raise rates from here. the big policy pivot has happened, and we do think the direction of travel is clear, even if the Fed stays put for longer than expected. And what does this all mean for bond markets? Well, investors have pushed back against fixed income in the last 2 to 3 years or so because correlation with equities has risen. However, I would say that this is because the shock we experienced in markets over that period was an inflation shock. Fixed income doesn't necessarily insulate portfolios from inflation. As the name suggests, your income is fixed. And if prices are rising simultaneously, then all else being equal, your purchasing power has eroded. But we do actually think that bonds today are quite well positioned for a couple of reasons. So let's look at each of them in turn. So let's go to the next slide. Firstly, as you can see here from this page, fixed income is actually offering higher real income. So this chart looks at the historical nominal yield on the 10-year Treasury, U.S. Treasury bonds in the blue line and the real yield in the gray line. So when we look at nominal yields today, they're at around 4.2, 4.3%. Real yield is essentially the extra yield you get on top of inflation. And so with inflation at around 3.3% today, this means that you're getting real income of around 1%. And these are levels that we have not seen for the last 10 years. And what this means as a bond investor is that you're getting paid finally to own fixed income. You're getting paid yields that are above inflation. And this, as a starting point, we think is very, very attractive. Now, what's more important is that when it comes to fixed income, starting yields have historically actually been a very strong indicator of future returns. So if we go to the next slide, just some stats that we think are quite powerful to really show to bond investors. So we remember that back in 2022, fixed income investments struggled because yields were very low and interest rates rose very aggressively against a backdrop of very elevated inflation. It meant that if you held a bond, it was likely that you got a very low coupon payment and also negative price appreciation. Now today, the situation is reversed. Bond investors receive higher interest because of higher starting yield. And if rates fall more than expected, there's potential for significant price appreciation. So what this slide looks at is the relationship between starting yield and core fixed income. So the Bloomberg US Aggregate Bond Index, that's x-axis. And then we're looking at the subsequent 5-year annualized returns for core bonds, y-axis. What jumps out immediately is that there is almost a linear relationship between the two. So the higher the starting yield, the higher the subsequent return. And using a regression analysis, we note that about 88% of the 5-year annualized returns of the U.S. Ag Bond Index can actually be explained by the starting yield level. But even without a regression analysis, this all makes a lot of sense. Yield to maturity can essentially be interpreted as the average rate of return that will be earned on a bond if it is bought now and held to maturity. I think Michele, explained this concept very well earlier. So as long as the issuer, keeps its promise, an investor can expect to receive approximately the starting yield and annualized total return for the duration of their investment, regardless of how rates or spreads change. So what we're saying is that starting yields tell investors a great deal about what the return could be if they hold a bond to maturity. Even though rising interest rates have, created a challenging backdrop for bonds in the last couple of years, we do think that this reset in yield has greatly improved their total return potential as we look ahead. Now, if we move to the next slide, I think, a concern often raised by investors who held bonds through the rate sell-off earlier is the risk of challenging performance if rates increase again. But I think what's comforting to know is that bonds today are actually much better positioned against rate sell-off. Now, the critical difference between a rate sell-off now and the rate sell-off begin in 2022 is that an investor today receives much more income because of the higher start yield. What we're showing here on this chart is the return of 2-year US Treasuries, 10-year US Treasury, and also corporate bonds in different yield move scenarios. What we're seeing is that should yields rise in the next 12 months by 50 basis points. So as you can see from the colored bars on the right hand side of this slide here, all else being equal, 2-year, 10-year US Treasuries as well as corporate bonds, they're still expected to deliver positive returns. And that's because the current yield on offer would buffer total returns by offsetting any price volatility. So higher yields essentially is providing a cushion to any adverse move in rising rates, allowing a lot of us to be patient while we still earn substantial carry. On the other hand, if you look at the left-hand side, should yields fall further during the next 12 months by 50 basis points, which is our base case scenario, there is potential for a lot of price appreciation, with the 2-year expected to deliver 4.8%, the 10-year expected to deliver 8%, and the US corporate bonds coming in with 8.3%. And then finally, if yields remain unchanged, which is the middle of the slide here, as you can see, we still earn a lot of income from owning bonds. And so, taken together, we think that given the current yield levels and the outlook, this highlights sort of the improved asymmetry that bond investors stand to benefit from the current environment. Fixed income returns are exhibiting positive asymmetry with a much higher likelihood of positive returns over the next 12 months because yields are high. So income is back in fixed income, and bonds should, at the very least, still preserve capital in addition to providing opportunities for return potential. Now, if we move to the next slide, I think, for a lot of investors who also own other financial assets, in particular risk assets such as equities, we think that owning bonds and having some duration in the context of your overall portfolio is going to be very beneficial, not only because of the return opportunities and the income opportunities we highlighted earlier, but also for the role that bonds play as a diversifier to the risk assets that we own. So what the chart here is showing you is what happens to equities in red and to bonds in green when you get a geopolitical shock or a market event. Equities, which are much more volatile, are typically subject to much larger drawdowns during market stress. The bonds, on the other hand, act as a hedging tool in the event of a growth shock. It's that diversifier that's going to add ballast to your overall portfolio when something goes wrong. And so, as such, I think it's very important to remind ourselves just some of the fundamental principles of fixed income investing that's going to guide our portfolio allocation decisions. So what else do we like in addition to core bonds? If we go to the next slide, I just wanted to talk through some opportunities that we see in the credit space. So given our willingness to embrace risk, we do think that credit, and in particular US corporate credit, is quite attractive at current juncture, given the carry, the underlying fundamentals, and also the overall macro backdrop. Now, within credit, we have a positive view on both investment grade as well as high yield corporate credit. But at the moment, we do have a preference for high yield, given the solid fundamentals of high yield issuers, as well as the healthy technicals risk in this particular market. So take a look at the chart on the top. What you see here is the high yield market breakdown by credit rating. The high yield market's quality, as you can see, has actually increased a lot since the GFC. So majority of the market today, over 50%, are actually in fact double B names. Double B names are essentially the highest quality within the credit rating spectrum for high yield. That number pre-GFC was only around 30%. So the overall high yield universe, as we see, is a lot healthier in terms of its overall quality and fundamentals. And we do think that high yield fundamentals remain quite supportive because companies have been quite prudent with the way they manage their balance sheet. They've done a very good job of cutting costs, becoming very efficient. We're seeing healthy capital markets, and the vast majority of the market is actually very well covered, and we don't see that deteriorating significantly, which is why default in credit continues to be very low. And that's what you can see from the chart on the bottom right here. This is showing you the default rate for the high yield market. And you can see that high yield default continues to be very low relative to history. So in the table there, you can see on average, we're currently looking at around 1.5% for the overall market. But what's interesting is that majority of the default has actually been concentrated in the part of the credit market we're very selective about, which is the triple Bs, whereas actually default for the higher quality issuers, the single Bs, the double Bs, is still very low. And we think it can continue to stay low, largely because firstly, fundamentals are still very supportive. And secondly, the interest rates that on average has been paid by high yield issuers is still very low. Majority of the high yield is fixed rate rather than floating rate. And because most high yield issuers have locked in lower rates back in 2020, back in 2021, when rates were at historically low levels, it meant that the move higher in rates since 2022 hasn't really impacted high yield issuers. So for high yield, there isn't really a wall of maturities that we need to climb in the near term. We don't think there is financing stress on default, and all of these factors combined should keep default rates relatively modest moving forward. And what about valuation in credit? I think that's the question that we do get quite a lot because spreads are indeed quite tight for both investment grade as well as high yield credit, meaning that valuation is looking quite stretched for the asset class. Now, while it is true that spreads are tight, and in aggregate, we think only modest spread tightening may be possible from current levels, we think it's actually quite likely that spreads will just stay tight and keep grinding along in a macro environment where the business cycle, where the economic cycle is extended. In other words, given that we think the probability of a recession is rather low, we're quite comfortable staying invested in this asset class, staying invested in credit, and get that carry. Because with a supportive macro, as well as underlying fundamental backdrop, credit is quite a compelling opportunity, especially for an income portfolio, given that you are getting a yield of over 7% in high yield credit and over 5% in investment grade credit. And I think this is probably a nice segue to the next slide, which is that there are still a lot of income opportunities that we see across the fixed income spectrum. So what this chart looks at is yield of different fixed income sectors relative to their 10-year ranges as well as median. Now, despite some of the rally that we have seen in the bond market recently, we note that current yields are still actually quite elevated relative to the last decade or so. And what this tells us is that fixed income still offers meaningful income, yield protection, and also actually relative attractive valuation from a total return perspective. Now, I've highlighted earlier some of the opportunities we see in core bonds, in high yield investment grade corporate credit. EM debt, we think, is another area that looks quite interesting in terms of risk-adjusted yield that this asset class is able to offer. So EM debt has performed actually quite well in recent months, and spreads have tightened. But we think the sector is still quite compelling when viewed from an all-in yield total returns perspective, with yields of around 7.6% today for emerging market debt. We are quite selective in terms of our exposure in emerging market bonds because EM is actually a lot broader than the handful of countries that talked about. And so having a very well-resourced fixed income as well as credit research team, helping us identify opportunities where credit fundamentals are improving, areas where central banks have more room to cut rates than those in developed markets, we think is going to be very, very important. And technicals for emerging market debt have also been quite favorable, given that issuers are in a strong fundamental position and that the asset class is actually quite under-owned. We do see some positive tailwind of flows into emerging markets by non-emerging market investors. With that said, I cannot stress enough the importance of taking really an active and balanced approach when it comes to fixed income investing. We do want a bond portfolio that is well diversified and very prudent when it comes to risk management. So if you go to the next slide, I just want to talk through very quickly what the bond portfolio looks like today. And we do think, in our view, we're quite positioned to do well in a soft landing environment as growth flows from here. So on the left-hand side, you can see that we're seeking really for attractive income opportunities across the fixed income spectrum. Some of our high conviction ideas right now include high yield credit, investment grade credit, and emerging market debt. We also like high quality securitized debt, which offers very attractive yield, along with return drivers that can be quite different from other parts of the credit market. Now, on the right-hand side, you can see some of the key characteristics of the portfolio. So we do have high carry. We have a yield of over 5%, much higher than cash. And because majority of the portfolio is currently in credit, portfolio duration is currently at 4.3 years, which means that as a portfolio, we're a lot less sensitive to interest rate moves. So all in all, we think about constructing a portfolio that's packed with a well-diversified basket of high quality as well as high carry assets with an average credit rating that is investment grade. We know that markets, whether we like it or not, are going to be choppy, which is why diversification of risk, we think, is going to be very, very critical in this type of environment. And the benefit of this fund approach is that we do have the ability to tap into various sources of income and allocate very, I would say, flexibly across a broad opportunity set to express our views. So all in all, I would say, income is back in fixed income. And, for a lot of the investors out there, we should very much consider building resilient portfolios by adding diversified sources of income as well as growth. So let me pause here. I'll pass the time back to Michele to see if there is anything to add.
Thank you. Thank you very much, Vivian. This was very interesting. And let me maybe kind of bring your last slide forward and talk briefly about the income investing portfolio that we offer on the StashAway platform, which obviously leverage what you just discussed and showed. And just a reminder to everyone, if you have any questions, I know Vivian obviously went significantly more technical than I did earlier. So if you have any questions, please feel free to use the Q&A function on Zoom, or if you're on YouTube, just write the questions at the bottom, and my team will help me make sure that I receive those questions. Okay, so what is the income investing portfolio powered by JP Morgan Asset Management? It's a Singapore dollars focused fixed income portfolio with the goal of providing capital preservation, so it's fairly conservative, with some sort of regular dividend. So the goal is to provide attractive yields and flexible payouts. while keeping your risk exposure low. One of the things that we did is made it very, very flexible to decide how much you want to pay yourself out, if anything. You can also decide to reinvest everything, and with which frequency. So on the app, you can decide that you want, monthly payouts, or you want quarterly payouts, and whether you want, $300 a month or $500 a month. Of course, we flag it when your payout is too high and therefore will over time eat into your capital. You don't want that. You want to have a payout that is at or below your expected yield over time. The yield to maturity in Singapore dollars is now 4.9%. I'll show you the bridge versus the 5.4% that Vivian mentioned earlier. In practice, the delta is the fees that are charged by JP Morgan, net of the rebate that we give back to client, but I'll show the bridge, I think, in the next slide. So yield to maturity is 4.9%. As you can see, this is managed by one of the best and largest and most respected income investors in the world, JP Morgan Asset Management. As mentioned, our goal is always to make things simple, and I think we did a good job here on making it very, very straightforward to use the product, and you can invest both with your cash as well as with the SRS. The portfolio allocation is what you see here on the left side, which is coherent with what Vivian shared earlier in terms of allocation to the various kind of different subsectors of fixed income. And on the right side, you see what the performance has been since we launched on the 16th of July, 2024. So the annualized performance since then has been 4.5%, which is in line with what you would. This is actually out as of 31st January 2025. I think February would have probably raised it a bit. But anyway, this is more or less in line with the yield to maturity that has been published since then. The reality is that over the medium term, you expect your performance to be in line with the yield to maturity. In the short term, you might have some fluctuations. You might have a month where performance is not, in line with this. Actually can be negative for a month, but obviously as you add time, the performance over time should actually land around your projected yield to maturity. So this is what I was mentioning earlier. Right now, in US dollars, the yield to maturity is 6.8%. So if you are trying to compare this offering with offering you see in other platform, and you see numbers in the 6% or higher, or 5.5% or higher in other platforms, they are showing you US dollars yield, which is not what you want if you want a Singapore dollars income portfolio. So make sure that you compare apples and apples. So in US dollars, the current yield is 6.82%. There is 1.4% hedging costs. Unfortunately, hedging is expensive. That gets you to the 5.42% that Vivian mentioned earlier. To that, you need to take away 1% fees from JP Morgan, and JP Morgan gives us a 0.5% rebate, which we give back to you. And so your lended portfolio yield to maturity is 4.92%, which for simplicity's sake, we actually publish as 4.9%. Okay, so that's. And the reason I showed this slide is that we try to be as transparent as we possibly can on telling you how this works. And we try to make things simple, so we don't give you the US dollar number that doesn't make any sense to you, doesn't mean anything to you, but we give you the actual lended portfolio yield to maturity in Singapore dollars. Again, other platforms, or maybe your bank, will actually often give you the US dollar yield, even if then you're buying a Singapore dollars product, which doesn't make sense to me, but that's what a lot of people do. So keep this in mind when you review different products, especially with income. This is what you, on the left side is what you see on the platform. If you invest in through StashAway and you kind of open your app, over time you can actually monitor the performance, and not only at the overall level, but also by single fund performance. So and as you can see, this is a portfolio of 5 JP Morgan funds that invest in the various parts of fixed income that Vivian mentioned earlier, from emerging market debt to credit opportunities to government bonds, etc. So it kind of gives a fairly broad exposure to different pockets of income. And this is kind of how it will show you on your app if you kind of want to see the overall overall returns. You need to click at the top to create a portfolio. You will land on the explore or customize, create a portfolio. You need to click on explore. And then from there, you're going to land where all of our portfolios are available. You need to click on passive income, and you will see the income investing portfolio available there. So passive income investing. And from there, you decide whether to invest in cash or SRS. And from there, you're kind of done in a couple of clicks. Now, if you want to know more about income investing, this is the QR code you need to scan. I'll stay on this slide for a second as I look for Q&A, and then I'm going to go to the next slide where I have another QR code with a discount code. So you want to stay on if that's what you're looking for. So let me look at the question that came in so far, and Vivian, I'll try to go through them and see if we can actually address them all. Okay. So the first question is, what will happen to bond interest rates during a recession? Will bond interest committed be honored?
Yeah, that's a fantastic question. So I think actually we had a slide, in the presentation earlier that shows where interest rates have been over the last 40, 50 years. And typically, what happens in a recession? Obviously, we have to look at what were some of the drivers of that recession. But typically in a recession, the Federal Reserve will lower interest rates to put a backstop on growth. That's what we saw, back in 2020 during the COVID pandemic era. That's what we saw, post GFC in 2008. We did see, interest rates essentially being very low for an extended period of time in order for the Fed essentially to support markets and to really support growth. Now, obviously, recession is not our base case. Here at JP Morgan, we have forecasted a 15% probability for a recession over the long run, which is actually one of the lowest probabilities it's been over the last couple of years. And so overall, we do think that moving forward, it's going to be quite a constructive environment, especially for bond investors because of these higher starting yields that we talked about earlier, as well as potential for capital appreciation as we look ahead.
Thank you, Vivian. There is, I think, a good question on U.S. Treasury. So with the U.S. debt set to increase together with deficit spending, we would expect U.S. 10-year Treasury yields to trend upwards. If this is correct, wouldn't my bond portfolio be losing value going forward?
Yeah, I think that's definitely a very good question, and one that is very, very topical. Obviously, the Trump administration has expressed a strong intent to really pursue an expansionary fiscal agenda, while dramatically cutting costs and really relying on revenue from tariffs to sort of offset that increased spending. Now, we did see, for example, Trump propose to reduce corporate tax from 21% to 15%. Now, our base case for now is that we don't get a decrease in that corporate tax rate. Rather, it would just be an extension of the Tax Cuts and Jobs Act that Trump implemented back in 2017. And mind you, these will expire at the end of this year. And so we wouldn't expect decisions to be made until later in the year. So new tax policy, extension of tax cuts, that's really going to be in 2025 or perhaps even 2026 initiative. Now, Trump's policy as proposed could definitely increase the fiscal deficit by 4 trillion as some have estimated. And we do think that the scope for fiscal stimulus could improve U.S. growth and inflation, which essentially, as you correctly pointed out, will raise the equilibrium yield for U.S. Treasuries. Now, while we do think that debt and deficit trajectory is a risk, we think some of the fear is actually misplaced because there are potential offsets in the form of tariff revenues, spending cuts, as well as other policy agenda. Now, in our view, we do think the most likely scenario for the next couple of years is actually status quo, which is that deficits remain wide and debt levels continue to rise. But a full extension of increased deficit and tax cuts and Jobs Act may not be palatable to members of the Congress who are worried about the debt deficit. And we do think that tight margins in both the House as well as the Senate do provide a buffer against this type of deficit expansion, and the dollar strength, I think, is a really good place to see that, because that is a real vote of confidence in terms of its reserve currency status. Now, the likelihood of the U.S. defaulting on its debt, we think, is very, very low. Now, technical defaults due to the debt limits are a different story, but we think that the likelihood of the U.S. actually defaulting on debt payments is very, very low. The U.S. benefits from issuing debt in its own currency, which is also the global reserve currency, and this unique position allows for higher debt carrying capacity compared to countries which issue debt in foreign currency. And so, despite some of the risks that we see from here, we don't think that's going to destabilize diversified bond portfolios because of the credibility of policymakers, ongoing investor demand for U.S. Treasury assets, as well as a very robust tax base. But having said that, with an eye to potential risk, I think it makes sense for investors to essentially, own international assets that could provide protection if we do see risk tilted to the downside, which is why we continue to advocate for a very diversified and well-balanced bond portfolio.
Thank you, Vivian. There are a couple of maybe quick questions that I can take. One is from Elvin: do we invest in a lump sum, or can we do it on a monthly basis? And the short answer is that you can, from a platform perspective, you can do whatever you want. You can invest in a lump sum. You can invest monthly, weekly, daily, whatever fits you, fits you best. From an investment strategy perspective, as you know, in general, we always recommend to dollar cost average into any investment products. This is a product with a lower risk level than some of the equity portfolio that we have, and so where perhaps is less required to actually spread your investment over long term. You can actually kind of be a bit more lumpy in your investment choices. Now, you can also do what we recommend always to do for the equity portfolios, which is to put your money in StashAway Simple or Simple Plus, and then kind of dollar cost averages from there. You can actually set an instruction to invest from Simple Plus on a weekly or bi-weekly basis or monthly basis to this portfolio, and kind of that takes away a little bit of the risk of timing the market wrong, meaning you maybe invest the day before interest rate spike for whatever reason, and therefore you have a kind of immediate loss that you see on the platform. Reality is that, as I mentioned, this tends to be short-term variation. If you actually take a longer time horizon, your expectation is to actually get, broadly speaking, what you see in the yield to maturity today, which, as we mentioned, is 4.9% after JP Morgan fees. And maybe I actually do have a question on this, Vivian, for you. Is that I thought that a killer slide was the one where you showed the relationship between starting yield to worst and 5 years return. And in practice, you have R square of 88%. In practice, what that means is that if you start at 4.9%, it's very, very likely that you get 4.9% or around 4.9%, more or less. Now, in what cases actually you don't? What needs to happen so that actually your initial kind of a yield to worst projection doesn't kind of end up or giving you the returns that you were expecting, 4 or 5 years later?
Yeah, obviously there are two sides of the story, right? In one case, we see higher returns, despite starting yields at 4%, and that is of course a scenario which is where we do see essentially the Federal Reserve, we see central banks cutting rates, which we supported bond prices. Now, on the other hand, vice versa. And this goes back to what I was saying earlier in terms of what happened in 2022. If we do see, for example, an inflation shock, where we do see a very aggressive move in terms of Fed funds rate and what the Fed does with its policy, we do see a huge move upwards in terms of interest rates. That's likely going to be a scenario that's going to be negative for fixed income returns. But all in all, we do continue to emphasize that starting points, starting yields for fixed income is at a very high level today, which means that there is essentially added cushion and added buffer to any kind of price volatility. And our base case is for inflation, to remain, relatively sticky for the remainder of the year, but not a scenario where we do see a dramatic pickup in terms of overall inflation. So overall, I would say bonds are still quite well positioned as we look ahead.
Perfect. Thank you. A couple of similar questions, which I think I will need to take. So one is, how long does the initial investment have to be held? Is the capital guaranteed and protected? I.e., will we get the initial investment back at the end of the term? And then the other question related to the first piece is, how long to stay invested in order to obtain the targeted annual yield percentage? So let me start from the capital guarantee, and then I'll go to the length. So the capital is not guaranteed. As mentioned, this is a low-risk product, but it's not capital guaranteed. So the capital is at risk, and you are investing in a basket of bonds, both government and corporate, which will fluctuate in value over time. The expectation is that you will get back more than your capital. That's the expectation. And as we were just discussing with Vivian a second ago, your expectation is to get more than that, plus around your 4.9% per annum return if you actually hold for a long enough period. Now, to the second question, what is a long enough period? That chart that Vivian showed was a 5 years return chart, and actually that's what we recommend on the platform, is a kind of a over 3 years old in time, just to make sure that you reap the benefits of the product. In reality, for those of you that have been already invested in the product since July, you see that even in this time frame, while there has been fluctuation between July and today, and so there were positive months and negative months, when you actually take July to January, you see that the return is actually in line with the yield to maturity that we've been speaking about. Vivian, would you answer differently the question on how long to kind of what is the right time frame to think about an investment like this?
No, I think you nailed it. I mean, obviously, this is a portfolio that's daily liquid, so you can be as flexible as you want to be in terms of how long you want to hold it for. But as investors, we do want to have a somewhat medium to long-term time horizon when it comes to investing, particularly when it comes to bond investing, where a lot of times we do want to hold bonds essentially to maturity, right? So to really fully capture both income as well as return potential over the market cycle. So no, I think you nailed it.
Perfect. Thank you. There is 2 questions on kind of competing products to get kind of a similar exposures. One is there passive income investing ETFs for these bonds? And maybe I'll take this one. There are ETFs that invest in bonds. Obviously, there is both corporate bonds ETFs as well as government bond ETFs. And on the StashAway platform, we have quite a few of them. In practice, we use ETFs to get exposure to a number of pockets of the fixed income world. Those are the ETFs we use in our core portfolios, and the same ETFs are also available in the flexible portfolio platform. There are certain pockets of the market that you cannot reach with ETFs, and there are some advantages of managing actively some of these pockets, like the JP Morgan team does. There are parts of the market that are perfectly easy to invest with the passive strategy, and other parts of the market where, for instance, some of the high yield and credit parts that actually an active strategy can give a bit of extra returns, which is why we picked the partnership with JP Morgan as we developed the product on income. Any different perspective on this, Vivian?
If I may just add, I think, a lot of the, mutual funds that we have on the JP Morgan platform, we are essentially using Sing dollar hedged funds because, income is such an important piece of the bond portfolio, and FX hedging in particular is a very important piece for that stability and consistency in terms of that income stream. ETFs, I don't think there are any Sing dollar hedge bond ETFs out there. So this portfolio is actually very much a multi-asset approach to bond investing designed specifically for investors in Singapore.
Yeah, that's a great perspective. And in practice, if you want to invest in Singapore dollars bond ETFs, you are restricted to very narrow asset class, Singapore bonds and maybe some Asian. But if you want to have a global exposure to fixed income and you don't want to take currency risk, in practice, you don't have an option with ETFs. That's actually a great point. And again, while obviously if you want to have US dollar exposure, obviously ETFs are potentially very good tools. There is another kind of a similar angle from Sanju. How do you compare fixed income portfolios with private credit from risk and reward perspective? Do you want to take this one, Vivian?
Well, I'm not an expert in alternatives, but I would just say, obviously, private credit is an asset class that's designed for a specific group of investors. Obviously, if you don't have liquidities, you're okay with putting your assets to an asset class that's gonna have a lockup for X number of years. There could be potential diversification benefits that comes with investing in alternative asset classes such as private credit, but ultimately we have to remember that as investors, we're essentially categorizing our assets into different buckets. And with this income portfolio, it is very much tailored for investors who do still want to have that liquidity on hand, in addition to getting a very nice yield pickup over and above cash.
Thank you, Vivian. And if I can add something, private credit is only available for accredited investors in Singapore, so not everybody can invest in private credit. It does have a very, I think, appealing risk-reward relationship for those that have access to the product. We do offer private credit on the platform, as I mentioned earlier, and we do have a lot of our accredited investors clients investing in the product. As mentioned by Vivian, it is, while that's a semi-liquid product, so it's not a classic closed-end fund, it's a semi-liquid product. So there is some liquidity, but it is a product that you want to hold for maybe longer. So there is a bit of a difference in the type of liquidity profile of this product, which is in practice immediately liquid versus the private credit one. But I invest in both just to, because I have kind of different pockets of my money that I invest in with different perspectives, and I invest in both because obviously this one is more liquid, the other one has a higher higher expected returns. And to the point Vivian did earlier, private credit is in US dollars, so you're taking currency risk, while on income is launched in fully hedged Singapore dollars, so you're not taking any currency risk, which is very important. Depending on what you're trying to do with this investment, obviously this makes a significant difference. It looks like we went through all the questions, Vivian. Thank you so much for being available and staying with us for more than an hour. I truly appreciate your time and most importantly your experience and your knowledge. Thanks also to everybody that participated and joined and listened in and asked questions. Hopefully you learned something. Hopefully you this was useful in your journey to become to understand more of how you manage your money and deciding whether this is an area that is interesting for you or not, so that you have all the tools at your disposal to make the right decision for you and for your family. Thanks again. Thanks also to my team that was in the background helping with answering some of the more StashAway related questions and setting together a little bit of the infrastructure behind this session. So thanks a lot, everyone. Thanks you, Vivian, once again, and looking forward to having other sessions like this in the future.
Thank you so much, Michele, to the StashAway team as well as all of our listeners. We hope that was insightful. So thank you very much.
Thanks a lot. Thanks. Have a good evening, everyone.